I'd like to welcome you to our IAFE session on electronic trading platforms. My name is Matt Gill, and I'm co-chair of the IAFE Technology Committee, along with Debbie Williams. And for those of you that are new to the International Association of Financial Engineers, we're a professional association that aims to support the quantitative finance field, really bridging the gap between academic theory and industry practice. And we have a number of different committees involved very actively in different segments of the industry. Our executive director, David Jaffe, will provide you with a bit more information on the IAFE right after the panel. In terms of the technology committee, we look at how technology is shaping the financial markets. And the last couple of sessions we've had have been on algorithmic trading. This evening, we want to take a step back and take a look at the wider issues of how electronic trading platforms are impacting cross-asset class, multi-asset class trading. There's no question that electronic trading platforms are changing rapidly, both in terms of who's using them and what they're being used for, both in terms of their connectivity and their reach. And one thing we're going to drill into tonight is how this is impacting the more complex asset classes, such as derivatives. And we have an excellent panel that's going to look at a whole range of different issues. And before we get going, I just have a few housekeeping points. One, I'd like to thank Goldman Sachs for hosting us here tonight, but also for their ongoing, very generous support of the IAFE, which is much appreciated. Second, our regular and formal press policy is that everything here this evening is strictly off the record. That being said, we actually are recording this session, as you'll see with the camera in the back, for the access from our IAFE members on our website. So this is being recorded. And very importantly, we'll be having a reception as well following the session. So I hope you can all stay for that as well. Finally, I'd like to introduce our moderator, Larry Tabb, who I'm sure many of you know. He's a very well-known, respected industry commentator and CEO founder of the Tabb Group. And I'd like to extend my personal thanks to Larry for being here tonight. And Larry, I'll hand off to you.
Thanks, Mac. I want to thank everybody for joining us. We've got a great crowd. Certainly, the idea of multi-asset class trading might actually be hotter than ever. I got a little speaker mic. Is that not working? Can you hear me in the back? Is it up? So, as I was saying, the only thing hotter than algorithms right now is multi-asset class trading. The problem is I don't know if anybody can define multi-asset class trading. We think about trading as being kind of a very focused sport, but now all of a sudden hedge funds, smaller asset managers, even larger asset managers start to think, hey, I can trade equities on it, why can't I trade options or futures or fixed income or foreign exchange or anything else? And I think that's kind of going to be what the discussion is going to be on. So with me to talk about a lot of these issues is a great team of folks that's focused in the multi-asset class, across asset class, or pan-asset class, whatever you want to call it, world. Directly to my right, I have Stephen Wilson. Stephen is the global head of exchange-traded instruments at Reuters, and he's been on the next-gen transaction and trading strategies for Reuters team. Next to Steve is Tim Riley, good friend. Steve is managing director of Citigroup. Good friend. Very good. Good friend. Global Markets, where he's managed electronic execution sale. Been there for a while. Next to him, another good friend. Chuck Garcia goes back, I don't know, 10 years. Chuck is BlackRock's relationship management group focused on new business development. He's involved with the solutions group over at BlackRock, kind of our buy-side person. And next to Chuck, another friend, Stefan Tutullo, and he's head of the futures for e-futures at Barclays Capital Markets in New York. And I guess the first question, which I'm going to start with Tim, is what is multi-asset class trading? And what do we think of when we think about multi-asset classes? Are the buy side going to all of a sudden start trading futures and equities together, or is it going to be how do you see this rolling out, and what kind of purpose? Is this a broker strategy?
Well,
Where do you see this rolling?
there's a difference between, when you talk about multi-asset trading, there's a difference between the kind of concept, kind of the whiteboard presentation, and the real application of it. When you look at the market, certainly there's the multi-strat hedge funds that are interested in this kind of technology, this kind of efficiency that trading systems, multi-asset trading systems allow. The application of this, whether it's a third-party vendor providing it or a broker-dealer providing it, gets a bit complex because when you talk about the actual trading side of things, we're talking about separate compliance situations, regulatory restrictions, support models, technology. So multi-asset is a very complex undertaking. However, like many things, and this is speaking on the sell side, if broker-dealers think there's demand for it and there's some money to be made, we generally build it and try to deliver it. And you see that happening right now. There's certain platforms out there, certainly in the execution management systems, the EMSs, that certainly do a pretty tight job on the futures, options, FX, and equity side. When you talk about the CDS market and some of the other fixed income products out there, I think it gets a bit more challenging to bring it all together. Some of that is kind of legacy issues about the kind of silos of businesses and within portfolio management and some other issues in the industry. But that's kind of the evolution.
Okay. Chuck, is this something the buy side really wants? Is it looking for it, or are your clients asking for, to trade cash equities and corporate bonds on the same platform?
The answer is, are they looking for it? I think I would assert they've been looking for it for years. And in fact, if you were to take the effect of your fixed income, you serve the needs of the buy side, and you understand that the buy side has to buy a treasury note. They buy the treasury note, and they buy it, let's say, to trade whatever through a dealer. A second later, or at some point later, they're hedging it with the treasury future. And it's conceivable that even after they've hedged it, they need to change the base currency to something else. So, for as long as I've been in the business, whether you speak hedge fund or buy side, they've been talking about multi-asset trading for a long time. And to many, even though it's a concept, we haven't weaved that concept into one particular definition. I think that there is a tremendous desire in hedge fund or asset manager to be able to look at a transaction as having potentially three or multi-components from different asset classes that are strung together for a strategy, with each leg of the transaction being dependent upon the successful execution of the other. So Larry, I would say whether we use that concept and we create that as a concept, it's been around for a long time. No one has yet to package it that way because the executions take place in so many different venues. Yet to the buy-side guy who was creating that strategy, it's one transaction.
Stefan, what's your kind of view of this? You look at this, not to say the bar cap is significant in the States, but you're certainly probably have a bigger position out in Europe and around the globe. And so what's kind of how do you see it?
Well, actually, it's a good point. It is true that bar cap has a pretty good presence in Europe and very aggressive presence in Asia. Historically, the US was not that strong. So we took the effort 5 years ago to go after the cross-asset class solution, to build our market share fairly significantly in a very short period of time. Right now, I divided the world into two types of world. You have the exchange traded world and the OTC world, and we've been spending a significant amount of energy, time, and money to build a platform which allowed our client to cross those lines. Exchange traded cross-asset exchange product is fairly straightforward. You're looking at fairly few numbers of pool of liquidities, and you have a certain, they're fairly standard across the industry, fixed examples. So the integration is fairly simple. Not easy, but fairly simple. When you get into the OTC world, it gets very, very sophisticated. And the market we took the bet to help our clients to integrate those two worlds, which is how to build our market share.
Stephen, you're from Reuters, you're certainly a global player.
back there is one of my eyes. I can't see a thing. So, I don't know if that's deliberate. It's certainly working.
We're trying to catch off guard.
Yeah, no, it's worked. And I guess that phrase, exchange trading, even like 2 or 3 years ago, people would almost say, well, what do we really do about exchange trading? It's equity, the rest of it is equities. And the fact that we've got someone there who works in exchange trading business and someone in Reuters, myself, who works in exchange trading business, is I think, symptomatic of the way that the world is going. It's what we at Reuters have finally worked out to, is that there is another asset class, even that's exchange traded apart from equities. So I run a business at Reuters which has revenues of around, I don't know, $600-700 million a year, which is all around the exchange traded space. And what we don't do anymore is we don't differentiate between a cash equity and an equity option and an index option and the oil markets, as long as they're traded on an exchange, as long as you define the instrument and it's traded in a regulated market. So I think it's that recognition, both from the vendor side of the industry and from the sell side, is a very clear indication that it is a reality as opposed to something that people have been talking about for the last 10 years. Because the whole idea of cross-asset, multi-asset class trading, everyone's been talking about it in the same way that everyone's talking about the fixed protocol in 1995 and saying, yes, it's great, we're all adopting it. But when you ask a room like this, how many people have actually implemented it? One person. So I think it's always the talk tends to be ahead of the reality of the development of these things. The other thing I'd say from a European perspective, and I'd like to bring that to this discussion today, is that unusually European markets have been in advance of the US, I think, in terms of markets innovation. Because if you see that the invention and growth of derivatives markets in Europe, they move very quickly from a period to be completely automated. They didn't have that intervening 100 years as you guys over here have had, whereby you have a physical floor and an approach to trading which really makes it very, very difficult to automate the trading process. It makes it very, very difficult to really trade across asset classes or across instrument sets in an effective way. So the legging risk is just too great. Whereas in Europe, we've been working in that environment almost for the last 10 years. So the idea of trading cash against derivative is business as usual. And I think the other thing is, if you look at the institutional investment community in Europe, that you go and talk to a Swiss private banker, you go and talk to a German institutional investor, they trade seamlessly across cash and exchange trading markets and fixed income markets all day, every day. So I think it's very much a phenomenon that is here and here to stay.
That's kind of interesting. When we're out talking with folks, buy-side folks, a lot of times, folks we're talking to are just kind of equity guys, and they don't know anything about foreign exchange, or they don't really know about fixed income. I think address this to Tim and to Stefan. Are we just talking to our own people, or when we're talking about multi-asset class, are they, does it start to break down a little bit more, or does it tend to be more the hedge fund guys, or does it tend to be, or is it just life is changing and everybody's becoming more efficient and the buy-side traders are looking to do a lot more?
On the backside, I would say the hedge fund community was the most aggressive community to endorse those processes. Historically, they come from the equity world. When I started this business, I used to make my brother, these guys who used to do the issues against equity baskets, against the spiders, and very soon they couldn't make any more money. The markets were getting so efficient. So they widened the horizon fairly quickly, and they had an effect that fixed income, and they moved very, very quickly. I would say the largest hedge fund in the US now, the most successful one, have broken every barrier they can think of. Actually, there's not one week I will get a phone call saying, can you help me break the next barrier, which is maybe connect yourself to MTS, whichever venue you are allowed to trade on as of today. An interesting comment earlier with respect to the European community embracing electronic trading a lot faster than the US. That's true, but if you look at the buy side, I would say the American hedge fund community was a lot faster at implementing. So from the sell side / exchange side, it came from Europe, but from the back side point of view, the core of the action came from the US, which is not very good. And the interesting comment earlier with respect to the European community embracing electronic trading a lot faster than the US. That's true, but if you look at the buy side, I would say the American hedge fund community was a lot faster at implementing. So from a sell side / exchange side, it came from Europe, but from the back side point of view, the core of the action came from the US, which is not very good.
coming very soon?
Well, yes and no. It depends on, that certainly if you look at what's been happening in the last 18 months, it's got to be on a panel and give a yes and no answer. It's so weak. In any case, a couple things. I think all the points about breaking down barriers and searching for alpha wherever you can, and really not being held to or defined by a single asset class as an investment strategy or investment manager is widespread and growing. I mean, there's so much innovation in our industry right now. It's a very exciting time to work in this business because of that. However, certainly the kind of legacy infrastructure, technology platforms, and really structural characteristic of a lot of the buy side, particularly the traditional investment managers, continues to separate fixed income and equities. At Citigroup, if I speak to a colleague of mine on the corporate bond desk, I have yet to have the situation where we're speaking to the same client. If we say, okay, we're talking client X, Y, Z, oh yeah, you speak to the same man or woman, that virtually doesn't happen. Very different in the hedge fund space. A lot more flexibility, but there's also less structural discipline in the hedge fund space between traders and PMs and analysts. I mean, if you have somebody at particularly in some of the smaller and mid-sized hedge funds, what they do, they'll say, well, I'm an analyst, a PM, and a trader. And if you go into some of the big fund machines,
And they clean the floor.
yes, and I'm the tech expert as well. If you go to some of the major mutual fund organizations, people are a bit more corporate, and certainly their roles are quite defined. So I imagine you're talking to some of the right people, but I think that this business is rapidly evolving, and there's just simply more people to talk to.
Well, I'm going to chuck it. Sometimes this is coming from a different perspective. We started his career at Bloomberg, and now BlackRock, and now BlackRock took over Merrill, and that's Hamlin. So you got fixed income, equities, and technology background. Do you see this kind of, separate? The hedge funds are different than the IMs, or the IMs kind of breaking down barriers, or what's happening at Hamlin, or I guess it's not Hamlin. BlackRock.
And it's now BlackRock. Well, actually, let me reference something that you stated, Larry. You wrote a report last year of the hedge fund community. So one of the assertions that you made in that report is that the hedge funds actually act like money managers. Some would assert that the money managers act like hedge funds. Now, statistically, we know last year, in 2005, hedge funds comprised 40% of all trading. That's in general. But in our organization, the way we see it, there is certainly a divide between the portfolio manager and the trader. When it comes to multi-asset class trading, I would continue to assert one thing that is changing is just the heightened sensitivity, even to an asset manager, using the word strategy. That's always something that we associated with the hedge fund. And in the asset management community, us being a dyed-in-the-wool asset manager, those strategies do exist whether we call them that or not. And the desire to be able to couple the transactions, to call that a particular strategy is very much there, very, very much at the heart of the trading strategies that money managers do in search of alpha. In particular, where we've seen that is with the growth of the credit default swap market. The CDS market has become enormous, but in particular, you can no longer buy the GE bond without thinking about how it is you're going to protect the credit default risk. So if you buy a GE bond, you buy a CDS, whether it's a single name or an index. The fact is, people expect, and the demand for the solutions that we provide in the order management space is to have what we call a look-through. It's no longer enough to know that you're exposed to the GE corporate. You need to know your entire exposure, including equities, to GE at every single level. The equities, commercial paper, corporates, CDS, you need to know it all. You need a system that gives you the parent-child relationship, not just for the parent company, but for the subsidiary. So we're seeing that. Part of the strategy, the trading strategy, involves buying a cash and derivative. And then the way you look at the world is as if it was a multi-asset class transaction that you want to package, couple together to see the entire picture. And that, I can't say 5 years ago, that's the way the world was.
So it's really almost analyzing and understanding the whole capital structure and being able to trade together, analyzing.
No question. And you could even state that if you bought a corporate bond, you have to beg the question in the equity market. Well, the fact is it's exposure to the name. You have to be able to protect against that credit default or whatever event occurs to that corporation. And that, I have to say, is much greater consciousness and awareness of looking at that whole as opposed to the individual parts.
On the technology side, is this also a way for the brokers and sort of speak here for Reuters as a distribution play as well? So I don't have to have 6 different platforms. I'll just put it all in one and just, here, take my nice all-in-one stack instead of saying, well, here's my futures platform, here's my options platform, here's my cash platform, here's platform to trade for each and puts or whatever.
What do we say?
It's called buy-side command and sell-side command, which is put it all together because it's not, we don't build 17 platforms.
Yeah, well, there are two parts of that. There's the whole OMS space, so it's the buy and sell side, how they play in the market, and how these guys actually deploy those for their customers. And that's been around for a while, and everyone does that in different ways before. But I think the point you're making is that for the cross-asset play, where the OMS vendors perhaps have been slightly slower to market because they've not anyway for the infrastructures, can't be quite as agile. A lot of the sell side have developed their own portal-based solutions to actually equipment to actually provide the capability out to the customer base. Now that's great if you've got a prime relationship and that guy just wants to trade with you. But of course the reality is that most people have a number of these relationships, and to actually don't tell them that. To actually standardise on the city or the weather proposition is great, but it means you end up having 3 or 4 separate technologies, with 3 or 4 separate infrastructure, with 3 or 4 separate workflows, which tends to make life difficult. So what we're finding increasingly is that people are coming to us and saying, well, if we can actually use, for example, the Reuters infrastructure, the Reuters global network, the Reuters data model, and we can just embed what these guys are doing within that container, for want of a better argument. That makes life a lot easier because it means that we can intelligently route order flow. We can use analytics across the different brokers in a much more intelligent way. And one of the ways that that's being manifested now is in terms of regulatory changes we're seeing in Europe, whereby people are saying, well, I need to get a much better handle on my transaction costs around both pre and post-trade analytics. But again, if I standardise on one broker solution, I can't then actually sensibly do peer reviews. I can't standardise on one set of technologies, which just makes life a lot more difficult. So.
Do you look at this as kind of an efficiency play from your side to have one platform as well, not just the customer demand, but also is it better to have one platform? Is it better to have multiple platforms?
Well, when you, I got that. Well, if I'm wearing my brokerage hat, it's better for them to have one platform, me to be the prime broker, than to trade with me all day. But that's not the real world we live in.
Get real.
Yeah, exactly. But
I actually meant it from the standpoint not that you versus a Morgan Stanley.
Yeah.
That's not what we'll do from a futures platform and an options platform and an equity platform.
it is far from optimal to be walk into a client and say, well, you have to take X, Y, and Z just to trade these asset classes with them. So not only do we want to deliver a single platform, we are a bit biased towards working with third-party vendors that provide multi-broker access because there is absolutely technology overload in our industry. You speak to clients and they don't want to talk to another vendor about their solution. They don't want to talk to another broker-dealer about the great mousetrap that we figured out. What they want you to do is make things efficient so they can focus on investment strategy and trading. And so working with the third-party vendors that can really consolidate all of this and offer access to trade with Citi, whether you want to trade futures, FX, equities, or options. That's we're big supporters of those kind of situations. I mean, it's as silly as people don't want to have a list of 15 logins every morning when they come in. It's a workflow issue. It's inefficient. So the consolidation across platform of the various products that a broker-dealer offers to clients is essential, and it's happening slowly, but it's absolutely happening.
That single sign-on question is just amazing something as straightforward as that. The number of times it comes up, I just want to run a single sign-on to get wherever I want to
a concept of single sign-on, but you can have single sign-on, and the tricky part here, Larry, is trying to find the right number that you're going to deal with. You don't want too many brokers, you don't want too few, because you're always going to be the issue of one diversification. So going to one multi-asset class platform is unrealistic, because nobody wants to go to one of anything, because when you take away the competition and you take away the diversification, you deal with multiple brokers to spread out the risk. You deal with multiple systems so that you can understand that there are other guys that are going to do something and try to do better than the one you have, because that's the way the world works. The single sign-on, the order management systems that have been able to propose the ability to get to a single sign-on and give people the conduit to be able to get to multiple destinations. The question is, how many destinations is right? And that's what we're trying to get to. You don't want a big team, you don't want one, you want someone who's there.
So let's bring Stefan into this a little. So do you as a provider of services, cross asset class services, I guess you really love the create a platform, but you kind of have two different ways of looking at it. Here's my platform for the guys that don't have a platform, or are you working through the OMS, or are you working through kind of a Bloomberg, or are you working
One of the above. So that's a great question. I like the analogy from Chuck. I mean, a few years ago when I started, I was in the execution business. I would say, I would give an efficient way to take the equity, whichever asset class. And I realized very early on that it was very, very hard to differentiate yourself. Because if you buy stock with Barclays, Goldman Sachs, we all going to offer you the same price, more or less. So we realized that we were going from an execution strategy to a packaging strategy. And when packaging, you package a lot of things. You package the execution, but the execution, as most of my clients are aware, they don't want to have all their eggs in the same basket. From an exchange point of view, as some technology, for some reason, my system goes down, they need to go back up. On the OTC world, you need to do the due diligence and you need to show the best price, best execution. However, you do have the clearing part, which is the financing part. And I feel very, very strongly that the execution piece will have less and less value from the revenue point of view for banks like Barclays, and support. And we'll be able to differentiate ourselves with packaging from the financing point of view. So, for example, typically a large bank, you will have the FX department is not be talking to the futures department. So if I'm running an arbing strategy, I'm going to be, let's keep it simple. I'm going long 10 yards of cash, and let's sell the equivalent of the futures. Because those large institutions tend not to talk to each other, I'm going to have to post margin on the cash, I'm going to have to post margin on the future, where actually I'm flat all day long, and that should not have to be posted. So we spend a lot of time and energy breaking those walls and saying, okay, we're going to do a portfolio analysis of your activity intraday, and instead of posting anywhere between 5 and 3% of margin on 10 yards of activity, your net exposure intraday is only $200,000, give me $2,000 and have a nice day. So that's where I put value right now. I take commoditized product, I combine them together, and I finance them efficiently.
Now, it's funny everybody's talking about the multi-broker platforms, that you can kind of do it all. I guess, but you see so many of these multi-broker platforms get acquired. So who's left to provide a solution? But who are the folks, are you partnering with, or is it, going to be a major market data guy like Reuters or Bloomberg, or is it going to be some of these little guys that are being, acquired, or inside guys like Bob that got acquired? I don't know. Who's going to be there?
I think it's important to point out the things we're talking about today, multi-asset, enterprise-level technology solutions. These things are extraordinarily expensive, and we're talking global. To maintain, to run.
Activity just the U.S. equities market. Difficult.
So you talk about some of these small and medium guys. Without the capital infused by somebody like Goldman Sachs buying them, they can't get to the level that's going to deliver what clients are demanding. So really that capital infusion, the gentleman on my left has a different situation because they actually do have a hell of a bank account. But for the most part, for the small and medium mid-sized vendors that actually have some incredibly innovative ideas and technology, it's not scalable unless they actually are acquired. Yeah.
Yeah, I mean, I've got two thoughts on that, and maybe it's slightly contentious, but I think the
Oh, let's have a big fight.
that's no fight. I think
Well, I'm sitting in my chair busting to disagree with one of you guys. Because I got a whole different point of view because I think you're all wrong.
okay, and I haven't even said anything yet.
I know what's wrong, but
I'm wrong.
I'm saying my perspective is going to be different.
Good. I think it's a little bit like at the moment because for the sell side, because he's got one, I've got to have one in terms of some of these systems, and it's the same as is going on in Europe, around the exchange mergers and the investments in alternative trading systems in general. It's a bit like playing roulette and saying, well, let me just put a counter on every single one of the numbers because it doesn't, the investment in the scope of things isn't that great. It's going to make a real difference to my bottom line. But I know I've got it. If this is the right one to be investing in, then we're going to win big. But I need to have one of these because everyone else has got one of them. So that's one side of it. I think the other side is that some of these investments, I think, are not misguided, but slightly short term in the sense that as soon as you take something which is inherently neutral and particularly broker neutrality is just such an important asset. It doesn't matter how much you talk to the customer base and say, well, I know we bought this thing, but it really is truly broker neutral, and you can route your order flow through this neutral hub, and go wherever you like, when it's the end of the flow, we'll operate it. It's highly autonomously. No one really believes it at the end of the day. And I think that one of the things that we were very clear about in terms of our positioning with Internet is one fabulous success, a fabulous investment. We took a conscious decision to actually divest that business because to us, the need to be neutral, to actually be the distribution partner of choice for the sell side to the buy side, to be able to help them distribute the assets that they want to distribute to our global footprint is so important. And I think to actually give that away, you almost can't value that in terms of the way that we position ourselves in the market.
So what phone do you have to take charge of?
I'm not so sure if there's disagreement, but I look at it from the point of view. Hear me out. I'm a fixed income guy. I represent an organization that historically was in fixed income. I spent years at Bloomberg and a few years at Tradeweb. And when we talk about multi-asset platforms, it is fascinating to me that in the fixed income market, look at the enormity, look at the size of fixed income and FX, and then take a look at the way the world has migrated toward trading in those two different asset classes. There are only two players in the fixed income electronic world that have taken hold: Tradeweb and Market Access. Bloomberg has a little bit; they've been trying to get into it for years. But if you look at Tradeweb in particular, I think that is a fascinating example of it. And Tim talked about the expense. The expense may be to the sell side, but these two firms, Barclays and Citibank, are both part of the consortium that started Tradeweb. Tradeweb is an extremely efficient and inexpensive system for the buy side to be able to deploy and to use. But what we're talking about here, the theme here, is multi-asset class and derivatives. What Tradeweb was able to accomplish is the ability to lock up a tremendous amount of the fixed income market for electronic trading, and then to be able to get a lot of the derivatives market, credit derivatives, interest rate swaps, and now repo. And there's only two players doing it in the enormity of this market. You look at the FX market, you only hear about FX all of these platforms. Now, is it conceivable Tradeweb will migrate to FX? Will FX all migrate to bonds? I don't know about that. But it seems we have a rather simple concept going on in multi-asset class trading that's taking hold. And that's those two organizations. I think it's a fascinating thing. I realize in equities there's a whole lot more going on, but it's fixed income. It's pretty focused and pretty contained and not expensive to the buy side of that.
Well, actually,
Actually, sorry, I have a question. Because we've been talking about a lot about derivatives, credit derivatives as well as industry derivatives. In terms of electronic trading, both on Tradeweb and Market Access, I have to say, this year the market really hasn't taken off that much in electronic trading. So I was wondering if you can give BlackRock's sort of view on electronic trading of indices and lists and things like that.
Yeah, well, first of all, BlackRock as an organization from the buy side perspective is a giant Tradeweb supported just in the cash markets. In the CDX market in particular, which Tradeweb has, Tradeweb doesn't publish the volumes for CDX in terms of the volumes themselves. They publish the percentages. It grew 100%. I haven't been there in a while, but we are certainly to look at the platform to the extent that BlackRock at the buy side definitely is a purveyor or more, definitely buy a cash bond and you buy the protection from the credit derivatives market, and he's a gigantic participant in the CDS and CDX market. The electronic portion hasn't taken hold necessarily because it's the newest part of it. TradeWeb kind of started slow with a very kind of a limited audience. It's only beginning to branch it out now. But electronic trading is very much a staple of the way businesses trade cash markets. It's conceivable that credit derivative markets are going to catch up. Maybe 5 years. I don't know how long it's going to take, but they go hand in hand. You cannot separate them. They are not looked at as doing in a vacuum. So I think we'll continue to see CDX and CDS grow up.
Yeah, I agree with you. And with respect to the train not taking off as fast as some of the players would like to, I'm not going to include myself as a firm, but I think the broker-dealer community have been trying to break that progression as much as possible. They were not very eager to have those markets to get more and more efficient. If you go see a prop trading desk and you say, I sell electronics, when I go see a prop trading desk, say, let me help you take those market electronic. I mean, they look at me like I'm going to build an electric chair and they're going to test drive it. I mean, they don't want it to happen. They're slowing the process as much as they can. So your prop trader is going to make markets where it's very wide, and they say, you see, nobody trades on the platform. It reminds me of the old days when they used to be on the floor in the futures world. The market makers say, add value, look, it's not happening, it's not happening. Well, they were doing everything in their power to make sure it doesn't happen. And I think it's happening right now in the broker-dealer community, but I don't expect it to last very long because the spread are getting narrower and narrower. They're making less and less money, so at some point, you're going to have to make up good volume. And the only way you can make up good volume is certainly not over the phone.
However, we continue to see the lessons as long as the buy side demand, even if it doesn't catch on eventually as well.
I got a question. My background prior to being in research is fixed income technology, fixed income operations, and can folks actually put together a real multi-asset trading platform? Because even in the fixed income world, you've got bankers' acceptances, CDs, commercial paper, VAs, treasuries, corporates, mortgages, asset-backed, munis, and each of these, even just fixed income products, are just 180 degrees different than the other ones. So with mortgages, you get TBAs and speeds and allocations, and it can just make your head swim. How do you put all this stuff on a single platform without just making it down to, okay, give me 300 of those and who knows how the hell it works? Can you do that?
Not only can you do it, it's already been done. I think that the market has shown that, particularly, I feel like particularly TradeWeb advertising, but TradeWeb has done a tremendous job of being able to get 2,000 institutions in a whole lot of countries around the world, not only in the dollar point of view, but in the non-dollar point of view, all the markets that lend themselves well to electronic trading, because not every market does. But what we're seeing, though, interestingly enough, is as it continues to take hold, there's almost the acceptance that, well, if it worked for CP, it'll work for BA, if it worked for BAs, it'll work for the next money market asset class. It's as everything is going that way. So the answer is, can you do it? Yes. It's been done already. It exists now. How far it's likely to go? Here's the big question. TradeWeb is a fixed income system. The question is, will TradeWeb have equity and FX? Will the equity systems, particularly from the equity guys, or even the exchanges, we saw now corporate bonds being published on certain exchanges. So can fixed income go to the equity side? Will equities appear on fixed income? That I'm not so certain. But fixed income, all of its asset classes can be put in one place.
Tim, and Stefan, when we try and tackle, do you have, can you get all this stuff on the platform and get it to interact? And,
Yeah, in many ways. I mean,
is it done kind of
is it necessarily one single front end? No. Will I give you a tool which allows you to build your one single front end? Definitely. I will give you a fixed value, for example, for FX or fixed. And then the front, which is integration, because its requirement might be from one client to another, the requirement is different. So I'm going to concentrate on the client, the stream of information, and then the client will decide which part it takes. So now
so is a lot of this being integrated at the OMS level, or
at the OMS level? That's right. It could be an external OMS, it could be an internal OMS, but it could be at the OMS level.
And that goes back to my earlier point, saying that we have a preference almost to kind of work with the core application on the buy side, because in order for them, if they have an appetite for multi-asset, that means their investment strategy is multi-asset, the way they're world would involve equities, fixed income, et cetera. So if we can, like you said, hook up a pipe, get the data going back and forth, get the information going back and forth into their core application, then we're getting there without having to almost go to the lowest common denominator to get a single front end to somebody that would allow for some level of trading. The challenge is, as I kind of referenced earlier as well, the LMS systems are a little clunky and a little slow to innovate, and that's a challenge for all of us. As a core application, and certainly a lot of our clients, the limitations of the current crop of order management systems are something I think that frustrates the entire industry.
I just that one question around where the liquidity goes and do some of the fixed income markets become more exchange-like? Do some of the exchange markets embrace some of the OTC market contracts? That's a really fascinating discussion, not for today perhaps, but I think the extent to which that is possible isn't down to trading paradigms or market structure. It's actually down to clearing settlement and risk, and the fact that you can actually manage that across the asset classes. And when someone can come up with a model, I think as you said, the fact that you can really, really efficiently cross margin, so that you're using your capital in the most cost-effective way. That's the market, the operator that's really going to win.
On the derivative side, it's very, very obvious. 5 years ago, I would have told you the CME would the CBOT, and everybody would have been laughing their head at each other with passion. I would not be surprised if the CME next would buy somebody like Broker Tech and combine with cash, and next thing you know, you're going to have futures, derivatives, you're going to have cash FX, you're going to have cash fixed income, and you're going to have a centralized clearinghouse which will take care of the credit issues. I mean, that would be very, very powerful, and I think that's what the industry is going faster.
So to a certain extent, we see these plays, yes, being delivery channels, and yes, being vehicles to get your brand out and get your products to market. But you think that the overall longer play actually is more of a marketing product. The complex issue is more cross marketing and settlement of events, and then all that else is back end.
That's what I do. I mean, execution is the excuse. Absolutely. I mean, I always use a bad analogy, but like I'm in a bar, and say, I'm going to make it very attractable to get the customer, but at the end of the day, I still find the same.
What is the bar analogy? Give away the popcorn?
Well, you make it very attractive. You build an environment where the person wants to walk in, and that's your service. Or a restaurant, you're going to serve a nice meal, but at the end of the day, you're going to make money with the wine.
You're not the one that actually.
Not because I'm French.
You're not the one that actually. You're the one that actually sells the books.
That would be fortunate to go this way.
We're talking about technology and issues. I guess, and I think Tim brought up that it's not inexpensive to build a platform. How do you see these things being paid for? Is this going to be paid in commissions? Is it going to just be paid for, like Stefan said, in terms of deal flow and margining and business relationships? Is it going to be, how does this stuff get paid for? Because it certainly isn't cheap.
Well, a number of ways. In effect, it's another resource that's being provided, whether that's capital or calendar or liquidity or financing, and there's a fee structure under it. Now, if that chit, if you will, is met through commission dollars, through margin, however we get there, we know the sell side at least, and the vendors obviously because it's an explicit charge, have gotten to the point where we're able to isolate to the dollar exactly what resources we're providing to our buy side clients. And whether it be paid through commissions or other fee-based structures, the sell side is also able to analyze quite accurately what our profitability is in the relationships we have with our clients. So, does it really matter to us if it's commissions, if it's people cutting checks, if it's via financing? It really shouldn't matter. It's a different challenge for the vendors.
Are you asking at the pay for the vendor, or are we making money
the buy side pay for these services, or is there a separate charge? I guess I'm sure Stephen, is going to say he's not giving this away. That he's either charging the back end who he's routing orders to, or paying for the front end platform.
It varies greatly from one asset class to another, depending on what we're trying to achieve. If it's an OTC, I'm a market maker, OTC or a platform. I'm buying liquidity. So the way I'm going to make money is I'm going to buy a certain market share. Hopefully, my trader can make money with that liquidity and generate profit, and they will find it. For them, it's a distribution. If it's an exchange trader, it's going to be a combination between commission, unfortunately, and smaller financing. Like it takes with the prime brokerage or brokers. It varies depending on what it is.
Chuck, since you're kind of a solutions guy with BlackRock, how do you look at this in terms of the illness? Is this just is this kind of come packaged in with the services that you provide, or is this, do you get hard dollar checks for this stuff, or all the above?
It's all of the above. It's hard to generalize on the buy side. There are plenty of buy side institutions that feel that OMS should be solved that way or something done. But whether it's soft dollar or not, you have just you have a large majority of institutions, hedge funds or even asset managers, that have the need to have a centralized order management system, irrespective of the method of payment. And to some, I would argue, they don't even look at it as that expensive. In fact, I think in some cases, the OMSs again are very, very cheap. And I think they could pay a lot more because it's become such a vital part of their operation to have a centralized order management system that makes them so efficient. So, while I appreciate the question, I think irrespective of the method of payment, it doesn't matter. They're going to get it. They're going to get what they want. They're going to pay cash and pay soft dollars. They don't care. As long as they have it and it does what they want it to do.
We have about a half an hour left. I got plenty of questions here on the list. I had someone likely enough to speak up.
Charles, I actually have another question for you. In terms of BlackRock, do you guys actually use the lenders release or the dealer provider software, or do you route all your information to your order management system?
BlackRock developed an order management technology many years ago that's actually offered out to other institutions as well. The answer is we use in BlackRock customers use an order management system known as Aladdin. BlackRock is both a brand, we have external business, and a division of BlackRock Financial Management. Everything is somehow contained and levered in the Aladdin system. So in order to get trade rep, market access, FXall, these two brokers, VIX, everything is done through the Aladdin system. That is the most efficient way that any asset manager is going about getting to all these destinations. So when we talk about the concept of multi-asset class trading, if you have an order management that is really at the focal point of the operation, so long as you have channels into all the other places, it's a very efficient way of going about your business.
I think just to add to that, one of the things that we see is there's so many acronyms now, EMS, OMS, EMS. Again, in the same way that we've all lived in our comfort of the silos, everyone knows what a data vendor does, everyone knows what an IBAN does, everyone knows what an exchange or liquidity pool provides to the marketplace. I think some of these definitions are blurring, and again, going back to that workflow comment, I think that the solutions for the future will be much more based around the automation of the entire investment workflow, so that the purely PMS vendors or the OMS vendors or the PMS vendors are all going to, there's going to be a lot of consolidation in the industry, and you end up with execution management and workflow tools which will just go from conception investment all the way through to trade and all the way back again in a way that really hasn't been done in a meaningful way before.
However, it is right now both the BlackRock order management system and to our competitors, Charles Riddle, Layton Zero, all the others, there is a lot more automation in the entire process than people think. The order is going to originate in the order management system. And the reason that we do it that way is because the order management system actually has all of the compliance rules that the order has to be read through. But the way the industry is now, the order gets sent to, say, Tradeweb Market Access, wherever. They do the execution, so it's sent, just you hit a button and out it goes. They take care of the execution. They send the block level execution back into the order management system that is matched against the allocations that were pre-allocated and then reset back to the broker for the allocation for the confirmation of net money. That is a process that took years to work out. But to the extent that you have an order management system that is able to support all of those, and most of them do, it works incredibly efficiently.
Other questions? Anyone back here?
Yeah, I guess the question for Stephen or Chuck. It's obvious in the equity markets why the electronic traded business has taken off. Fragmentation, price discovery, increased volumes, all reasons why, greater efficiency. What are really the drivers that are pushing forward on the OTC side? Is it a pure efficiency play? Is it linkage with the other products directly? Are those the things that are pushing it forward? I mean, because as you say, in your OMS now, you can look at the risk and those sorts of things together. But what's really driving it?
I'll take it and I'll defer to others. We can talk about technology until the cows come home. There is a concept that you touched upon that is the most important driver in that, and that's liquidity. That's the view, the ability to look at the liquidity and get the best execution possible. You could have a widget, or you could put a man on the moon. It doesn't matter so long as you can be assured of one other concept in addition to liquidity. You have liquidity concerns that you're able to look through. And then second, which is more important than that, given the fiduciary responsibility of an asset manager, is you have best execution. We haven't even discussed that. And they do not, they are not mutually exclusive. They have to go hand in hand. The drivers of all of this efficiency come down to what is very fundamental, that has been fundamental in this business for years, and that's the ability to achieve the liquidity desire that you need and to get the best execution. Everything else is secondary to that.
I think the point about liquidity is absolutely key. We used to live in a world where price discovery and liquidity discovery were very different processes, whereas now they're really one, and it all comes down to, and it's worth spending a minute on best execution, because the regulators have finally woken up to the fact that the best execution is handled in a sort of what's the right term? It isn't handled, it's what is it like, should we say? So you've got, in terms of regulators, but the regulatory change in Europe with the MiFID regulations is really the biggest upheaval, the biggest structural change in markets that I think we've ever seen, and that means that the whole investment process around discovering liquidity, how you've chosen where you want to execute this particular program. Why have I gone to my friend on the right here? Has he really proven to me that he's met all of the best execution criteria according to the test that I've actually set? So I think it's just going to be a much, much more complex world in which everyone's going to have to work.
Can I add one thing to that, just with respect to best execution? It's to the point now where what's really the driver for electronic trading is the ability to demonstrate, to prove that you actually sought best execution and you actually executed on the thing that came back to be the best. And with electronic platforms, part of the functionality is being able to store that audit trail for when the auditors come and they ask you, can you prove to me that you did, that you got the best price from Barclays, you can easily demonstrate that. And in the manual world, you couldn't do it. The pressure is very much there for the best execution to be able to demonstrate.
So in the OTC world, it's being able to demonstrate the RFQ model?
Well, not necessarily that, in the fixed income world, the RFQ model is, that's just the way the model exists, and that's the way the platforms built it, because that's what they were asked to do. But I think you can say not necessarily as others.
Yeah, for example, at Barclays, we stream to both government bonds on the run, and we have partly been connected to multiple liquidity, like Tradeway, Barclays, and some other platforms, and we'll be able to put that at that point of the day when they bought 100 million worth of government bonds, they bought the best price on the street. But the important part, before it was kind of a nice tool, it makes your life easier, but now it's becoming a legal necessity. As a fund manager, when you're going to go see your investor, you're going to be able to have to prove it. The old days saying I have a good relationship with Borman, I don't speak on them. But because I've known him for 10 years and we have a nice dinner together once a month.
They're sponsoring this conference, so I
Well, they're fair. Or Barclays. I mean, those days are over. You're going to have to prove it, you're going to have to be able to produce audit and be able to show that your system is smart, knows where the liquidity is. You're going to have to use TWAP, you're going to have to do BWAP, you're going to have to slice the orders, and then become a lot smarter. Look in the equity world right now, if you look at the liquidity, the visible liquidity of the market, there's a lot less level visually. So you have to come up with very, very smart system which allow you to execute your orders very efficiently and very, very low impact. And if you cannot do that, well, your return as an investment firm would be mediocre and you'd be out of business.
And also, we're talking about the asset management. The question is with respect to the hedge funds, how much regulation are they going to have? Are they going to have the same requirements? Because they're the users of these same systems. So we'll see.
Tim, you want to add anything? Or?
Oh, well, I would just say that, when you talk about that, the fixed income markets getting religion on transaction cost analysis over the last few years, that's been our MO in the equity business for 10 years. It's something where it's been institutionalized within the equity business. So it's interesting that it's moving to the fixed income world. We used to make a lot of jokes about, well, there's no tape, so what the hell's going on upstairs? Our fixed income traders are upstairs. But getting back to the topic tonight, as far as kind of multi-asset platforms, I think it's interesting. When you talk about transaction cost analysis, developing the kind of tools that can go look at your investment strategy holistically across asset and analyze really what best execution is across a multi-asset strategy. And that kind of technology certainly is an opportunity right now.
I think that's a really good point, because one of the things that some people have missed in terms of the MiFID, everyone assumes that in Europe it's just relates to equities, but it's best execution across the board. But when you go to the regulators and say, well, okay, so what's the benchmark we're going to use for this fairly complex synthetic trade that I've done across all of these different asset classes? And they say, what do you think? It's very difficult in the sense that regulation can come into force in pretty much 12 months' time. And the regulators don't really have a clue how they're actually going to provide measurement yardsticks that everyone here is have to use.
That's actually an interesting idea. Topic I prepared for another day, but certainly the exchange trade stuff is pretty straightforward. But even things like foreign exchange, just look consolidated case. There's a question right here.
Yeah, I guess as exchanges get larger and larger and more things are advertised on the exchanges, how is the buy side going to differentiate which broker to go with? And if the broker is going to go into the same exchange to buy the security, I have only one shot to go with one broker. And so how do I differentiate who to go with? And if all the brokers go send me the letters that guarantee that guest will do that security, and they will be going into the same place to get this bond or whatever for me, so how am I going to decide what factors I should look at?
So the question, I guess, is if everybody's swimming in the same swimming pool, how are the different swimmers going to differentiate themselves? Or fishermen going to differentiate
It's
themselves?
very straightforward when packaging. How I'm going to finance your position across all those products and make financing clearing side more efficient. Across the second barrier, making sure that I look at your FX quality against your future. I look at your entire portfolio, and I don't just look at every single portfolio. Every single product. I'm going to look at your entire investment as a total portfolio and try to find out the negative correlation and give you maybe the margin in some occasion or be trying to
I'm going to have an argument that my financial engineers are better than your financial engineers. So when I'm building my model, when I'm building my technology, when I'm designing how I interact with market from Citigroup, I think I'm doing it faster, better, and more efficiently than my opponents. And that's what I'm going to try to sell to you. I mean, in the TCA world, as I referred to earlier, I mean, we're measuring everything we do all the time, and sometimes we win and sometimes we lose, and often, the sophistication of the clients has dramatically increased. A lot of it's about the tools they have on the desk and the way they're able to measure your performance. So you can go in and I can go see a client and I'll say, we're not going to be dead. We're doing a great job. Look at our numbers. We're beating all these benchmarks. And they can turn to me and say, well, not according to my report. As a matter of fact, out of the 10 brokers I have, you're 7. What do you think about that? And that's going to make your decision easier as far as what broker. So if you have the tools to measure what execution channels you're using and how you're using them, I think you will see around the edges a certain differentiation even at the top, but the difference between your 1 guy and your 10 guy should be pretty significant.
Aren't we also seeing the development of all these dark pools and all these crossing networks that are in effect trying to, I wouldn't say muddy the water, but better leverage or internal order flows to affect the able to get your clients better pricing. And if your liquidity pool that you're matching is much bigger than the next guy, hopefully you're doing a much better job of internalizing and lowering that price.
Well, I think, and we're kind of touching on different markets today, whether you're in fixed income or equities or derivative product or FX, if you have a unique pool of liquidity, I find that clients are seeking it out and looking to have access to that. So if whether it's a dark pool on the equity market or another structure in other asset classes, people will pay for liquidity or they'll seek out liquidity. I have to avoid a lot of questions you're going to keep asking me about how do broker dealers make money and financial engineering, a multi-asset platform. How do the broker dealers make money? I don't think that's what this audience is really interested in.
I think I'm glad someone mentioned the I word, internalization. Because it used to be something that everyone knew, but no one really talked about in terms of the way to manage down costs. And I think, again, Goldman, I haven't mentioned Goldman, yes, I will now. The fact that they go out public now and say, look, in the new world, what we're going to do is we're going to have a policy of internalizing flow because we think we're going to prove to you that we're going to get better execution by actually doing that. We're going to reduce your costs because we haven't got to go to market and pay all these nasty exchanges, all the fees that they charge us to actually do that. Now, how successful they are or not, who knows? But in terms of a strategy to say that we will actively internalise as much flow as possible so that we get best execution is really an interesting play.
It depends on the client too. I mean, I build a business by doing zero internalization. Some of my clients don't want
Absolutely.
They don't want some prop traders watching their flow and I can generate what they're doing. And that is a big issue. Is it worth saving a couple of pennies and have somebody watching you trading all day?
Some of the stricter processing challenges where which is a further possibility asset classes that are based on the race of our people and where some of the greatest opportunities?
The question was really around STP and where are the glitches and where are the opportunities to really make that better?
Historically, my own experience, we spend a lot of money on the front end, it's sexy, it allows us to sell very quickly, and then the back office tend to catch up. Because you go see managing directors that want to spend $100 million because they need to work on my reporting capacity. You don't get much attention. You want to spend $100 million because you're going to increase revenue by 50%. You get the budget. So typically, we tend to push the front end very aggressively, and then the back end say, help me, and at that point, say, okay, we really need to spend more. I mean, it's not something the industry likes to say. Typically, you need to make the sale first in order to justify the expenses of the back. But we've spent a lot of time and energy to across our experience across asset classes. What you've done in equities can be replicated in futures, it can be replicated in FX. I mean, it's fairly similar, and there's a lot you can do there. So you can move very, very fast, and it's very, very scalable.
Let me add, I'll get to the opportunities and to the problems in just a second. For taxable fixed income, for equities, all of that, straight through processing, it's worked out, we're doing just fine. Where the chinks in the armor tend to occur is when the innovations from the investment bankers occur faster than the system's capacity or ability to handle that particular asset class. CDS is the perfect example. When you trade a treasury note or bond, what's the big deal? You buy an equity, it goes from the front to the mid to the back, done, it's straight through processed. But when you introduce the innovations that they introduce, which are very good innovations and have their place, but particularly when you look at the terms, particularly of the CDS, that was a very difficult part for people to be able to work out the settlement process and the counterparties being able to agree on the terms because it's not so simple. So long as these innovations continue to occur, and nobody's saying they should, they're very good things. There's always going to be that catch-up. What buy-side firms have to do, here's the toughest challenge we see from the buy-side when it comes to straight-through processing. Do the systems that they've developed today, are they constrained from being able to buy an instrument? The reason I say this is I deal with a lot of prospects, particularly insurance companies, that know they need to be in the CDS market. They are not in the CDS market, and they feel really left behind because the systems that they build do not have the capacity and they're too constrained from buying an investment instrument. That is really dangerous. And this gigantic insurance company that we deal with, that just never worked out CDS because nobody thought, well, why should we? All of a sudden, they're really struggling to very quickly find a solution that can handle the capacity to do the straight-through processing for that asset class. Now, some people have already thought CDS through. The question is, what other asset classes are going to be coming down the pipe, and you can be sure they're going to keep coming? Can the systems be scalable enough and look forward enough to be able to handle the next innovation? And that's not easy.
Along the same lines, if you have systems that can handle the processing, you also need messaging and connectivity. So what would you forecast as being the standards? Is it going to be FPML or Swift or FPML over Swift, something of that nature?
Yeah, well, that's an interesting one. I was talking about exactly that this morning, because in the exchange trading space, there are two things going on. Everyone, if you go and talk to every exchange in Europe, and you go and talk to the guy who runs technology, and you say, is standardization of messaging in data? Yeah, absolutely. 100% support it. It has to happen. And they'll say, but as long as it's our standard. And you go to the next exchange and say exactly the same thing. We love standardization, we want to do this, it's going to take great efficiency in the marketplace, but it has to be the Deutsche Börse standard, it has to be the London Stock Exchange standard. Because at the end of the day, what these people are doing is if they're in a fight to the death of liquidity. And one of the ways that they actually make liquidity sticky is by having protocols which are unique to their particular market construct, their market. So once you win that interface, it's difficult and expensive to move away from that. As soon as you start standardizing on Swift or FIX or any other industry-wide protocol, it means that the liquidity becomes much more fungible. Someone with smarter technology or a better post-trade process that really leverages clearing can actually move that liquidity very quickly, and that's just not possible today. So I think it's a real difficulty.
I think it's not really a big argument because the broker-dealer community does standardization for one single format across all asset classes, and I will be the one doing the translation when it comes to that. So I don't see it as a big. I mean, with the exchange, I'm a little emotional about the technology, and they have some type of edge. But long term, at some point, I think the cost benefit will not be worth it for everybody, and will come up.
Well, that's what happens with standardization generally. Folks have their own proprietary protocols. They get locked into those protocols. To change those protocols becomes very expensive. Eventually, their customers force them, and usually the ones that hold out the most are the ones that get the most hurt. Because the only reason they would change to an open standard would be because the liquidity is already left, and to try and get it back again. But people, I agree with Stephen. It tends to be these folks, and it's not just exchanges. I think it's even technology providers generally believe that the thing that protects them is their closedness, and by opening them up, they tend to lose more than they gain. And I think actually it's the opposite. But it's very hard to get folks to change, at least the way I've seen it. In the back.
When you have multi-asset classes, you typically have, on the sell side at least, you have multiple salespeople covering an account, say a hedge fund, for example. What happens to all the salespeople? Is your view that e-trading will replace a salesperson or complement a salesperson?
The question was, for those of you who didn't hear it, is that the sales side tends to be very siloed with multiple key people covering similar accounts for different product sets. What happens when you have an integrated delivery channel? Does it, do all the salespeople just consolidate to one guy covering an account, or half a guy covering an account, or half a girl covering an account?
Definitely not. I can use an example of back to the future side, 100% electronic front to back. We actually grew our sales force by 20%. Do you sell the same type of services? Definitely no. You're not going to be selling plain vanilla execution. say, buy me 500 contract. Those days are over. Those guys will spend their day coming up with sophisticated, complex strategy, and they're going to spend their time coming up with added value strategy. The plan value execution days are gone. However, I've been at Barclays 8 years. I think we have not lost one single salesman on the future days. We actually have a salesman. If you're not willing to adapt, if you're not willing to embrace those changes, yes, you will lose your job. However, this is not the end of the salesman. You still need to have a level of communication. Somebody needs to understand the needs and requirements of the exchange, bring back the information within the firm, and make sure we build the next generation of tools which we need.
But what about the trader? I'm sure everyone saw that IBM study that said in 10 years' time.
What about the typical trader changes? I mean, you're not going to see the old cherry picking where, it's column A is not that sophisticated, we're going to make it a little wider. Those days are over. So your trader might not be a relationship trader. He might become a quant person. He might have a background in nuclear fusion instead of being more of a socialite. But you still got to trade.
I'm going to have to push back now. Well, I'll tell you what we've seen as far as kind of, if you look at, combining or breaking down silos, however you want to call it. First of all, if you look at the equity markets, Citigroup in 2001, it's something like, and this is cash single stock trading. I think we had a little over 100 traders, NASDAQ listed ADR. Not just cash single stock trading. I think today we're somewhere in the 30s. 6 years. We used to have different sales traders for ADRs, OTC, and listed. Rapidly, that consolidated. Today we have sales traders who trade derivatives, all single stock products, programs, structured products. So I actually do think you do see less sales traders and by extension salespeople. The interesting thing is the explosion of hedge funds in this country and globally. We actually have probably net increased the amount of salespeople basically because there's more accounts to cover. It used to be about 50 important investment managers, and and now I think there's something like 1,200 hedge funds that we service. So there's more salespeople, less execution-focused people because technology and automation has taken over a lot of that. That's our experience. And traders, like I said, the ones that were hanging around cherry picking, they left a long time ago.
Well, you can reach us.
This is mainly for Tim and Stefan. First of all, how important do you feel that pennies, options trading in pennies, which will start in January, will be to grow the options trading? And how important is it to your customers, not only multi-asset trading, but to have strategies and to have algorithms to trade those options so that you have automated delta hedging and making markets volatility space, and full disclosure on what reflects their systems?
The question really was around penny options and how's that going to impact them and what do they expect and how's all that going to integrate?
It's funny, I was meeting about this very topic last evening. Internal. Trying to figure out what the hell we're supposed to do. In any event, I think that I think that your question answered itself in effect. I think the move to a penny market, if you will, opens up the ability to create efficiencies through options trading and more electronic products. We struggle a little bit with some of the market structure issues in the options world, and the lack of automation with some exchanges. That certainly limits the scale and the scope of what you can deliver in that space. But absolutely, I think that the evolution of that market to a penny market will open up all the strategies or many of the strategies that you're describing, and it's something that we are actively pursuing at Citigroup.
I agree. Because if you make less money on transactions, you tend to increase your transaction.
To the back.
I have a question regarding electronic trading for natural gas. Are you familiar with any platforms that are out there, and you see an opportunity, for electronic trading in natural gas.
The question was, do we know any platforms out there for trading, electronically trading natural gas? And personally, I'm not familiar with that market. There you go.
You can trade on ICE. Intercontinental Exchange.
The ICE.
It's available on the. Yeah,
So you need to have $100 million in
We'll lend you the money.
In the back a lot.
I'm curious, are there any true multi-asset class trading platforms? I see that many firms have one solid platform for futures, one for equities, one for FX. But are there any true integrated platforms for multiple asset classes?
My question was, are there any true multi-class platforms that are out in the market today?
Are you referring on the broker-dealer side or on the vendor side?
Either.
I think yes to both. Not to a full extent, but I think you have hybrids. You have 100% of all asset classes, no, but I know flex traders in the room and portfolios in the room and spend a lot of time and energy to support process and class technology on the bank side. And on the bank side, we are actively involved as well.
Do you have a Barclays?
Yeah.
Just continue on this thought, because it's interesting. Right now, we actually use different order management systems or different tools that specifically address certain asset classes. Right? There's one vendor is known for their futures, let's say, a platform that we use. Another vendor is known for the treasuries and so on and so forth. Now, if we were to go the route of one system or one platform for all of them, then is there somebody there who can deliver all the reach set analytics and all this free trade stuff and the trading? You're looking at all the pools of liquidity, and I agree that's a good idea where you can actually see different asset classes, how they behave, how they act in relationship to the one that you're trading. But at the same time, is there really a platform, a gigantic platform that's going to allow you to really go deep down into the, into this deep type of approach?
No. It's a bit like a set of Legos. I will give you the cubes, and then you're going to put them together depending on what you're trying to achieve. I'm not going to be able to come up with a model that meets everybody's requirements possibly.
I'm going to disagree on the buy side. I think they already do exist. There are a lot of order management systems that traditionally started in a particular asset class. We knew Charles River and Redwood in particular, line data as being very equity-centric. However, they do a fine job on bonds. We see in the BlackRock system, very fixed income-centric. Given that Malone was just integrated, it's only a matter of time before we're going to catch up on equities. Everybody is playing in the futures and everything else. I think in another 5 years, if we come right back to this table, these order management systems are going to be capable of handling any kind of asset class, so long as there is some standardization to the connectivity. And the fixed protocol has gone a long way in aiding and really allowing, as an enabler, allowing order management systems to reach anything, anywhere, any exchange, any broker, it doesn't matter. And I think everybody is going to be able to handle all of the asset classes sooner or later.
And you think it's going to happen by purchasing those boutique shops or by
you don't have to.
your own one?
You don't have to anymore. The communications are such that so long as you can plug in somewhere, you don't care. It doesn't matter. So long as you have access or a channel to some other place, they're all going to look a lot alike. You won't see as much differentiation that Charles River dominates in one and McGregor dominates in another. They're all going to look alike.
Actually, I do agree with you. The point I was trying to make, as a broker dealer, as a bank, I'm not going to spend a huge amount of money building it. I'm going to work closely with those vendors, those partners, to give them the Legos, which will allow them to put together the solution. But I don't want. If you're an hedge fund, you're fund manager, do you want to rely on a platform which is owned by a broker dealer 100%? No, obviously not. It's too much risk. You want to have access to those guys efficiently, and then build your own internal platform, use a third-party neutral platform, which will allow you to build that solution. But as a bank, I don't want to offer.
I would like to begin comment on how the technology itself will have
These
Question
trains,
was, would anybody comment about the underlying technology we using object-oriented or .NET or Java?
I don't know, it's a bit like fashion, these trains, when they do
Let's, I think we got one more question. Auction it off. Okay, here's someone who hasn't asked a question.
What do you think about the possibility of having overlays on the existing OMSs or platforms to handle dynamic strategies or model-based strategies?
I think it already exists. I think there's plenty of platforms out there that complement the order management systems. I said earlier, a lot of the order management systems, they're a little kludgy. They're improving, but they don't really have the resources to do some of the most sophisticated strategies. So what a lot of third parties as well as broker-dealers have delivered and developed are applications that complement the LMS and interact with them. A great example in the equity markets is LiquidNet. LiquidNet shows up right in your order management system when you have a pair, so it sits on top of it. We're already there, and I think certainly until we get to the dream scenario in 5 years, I think you'll see a lot of them.
No, I think that's a good point, and this is something we're focused on. I think the heavyweight deployed buy-side OMSs, where you've got a time to market for algos, for example, which is measured in many months versus the time by which time the opportunity to go for that algo may have passed. And what we've done, again, standardising on fixed, is give the brokers control of the ticket